Welcome to Stat Plus, where we enable smarter conversations wherever you go. In today's video, we're breaking down how the United States of America's latest tariff strategy isn't just about protectionism. The Trump administration's recent tariff strategy, despite its 90-day pause, still signals a clear objective: reduce the United States' widening merchandise trade deficit. Despite the reciprocal terminology, the administration is not simply matching other countries' existing duties. Instead, they're calculating how much additional tariff pressure would be required to offset bilateral trade deficits. The formula revealed in the White House documentation clearly illustrates this approach, even as tariff implementation has become more selective and strategically targeted. From Washington's perspective, increasing tariffs is a tool to compel other nations to import more from America, starting with crude oil and possibly extending to commodities and even manufactured goods. Strategically, this also challenges China's long-standing manufacturing dominance. However, as we've examined in earlier discussions, relocating global manufacturing operations to the U.S. remains economically unviable for many companies, including American ones. High labor and logistics costs, overhead on input materials, and the absence of low-cost manufacturing clusters make such a shift prohibitively expensive in the near term. Instead, the real disruption could be felt in the global crude oil market. Since crude is among the few commodities that developing economies can viably import from the U.S. in large quantities, OPEC plus nations, including Russia and Saudi Arabia, are directly in the crosshairs. Saudi Arabia's reaction has been swift and telling, cutting its official selling prices for May deliveries by $2.30 per barrel for Asian buyers. Simultaneously, OPEC Plus announced a surprising production increase of 411,000 barrels daily, triple their original plan, further pushing prices downward. For India, this creates a substantial opportunity. India imported approximately 240 million metric tons of crude oil in fiscal year 2025 at an average price of $76 per barrel, amounting to an annual bill of around $135 billion. A drop to the $60 to $65 per barrel range could translate to savings of over $20 billion in the coming fiscal, massive for an economy that imports 88% of its crude oil needs. India has already begun realigning its energy sourcing. U.S. crude imports into India surged by 67% in March, reaching 244,000 barrels per day, up from 146,000 barrels per day in February. With falling prices, shifting volumes from OPEC nations to the U.S. may not incur incremental costs, making this transition economically sound. If India can reduce its current $45 billion trade deficit with the U.S. to around $25 billion through increased crude purchases and strategic defense deals, the effective tariff rate could be limited to around 10%. And even this reduced impact would be partially absorbed by higher U.S. inflation and exchange rate variations. Now let's hear from you. Do you think India should increase its crude oil imports from the U.S. if it helps reduce our trade deficit and energy bill? Or should we focus on keeping our sourcing diversified? Let us know your thoughts in the comments below. Thanks for watching. If you found this analysis insightful, please like, share, and subscribe to Stat Plus for more updates. Whether you're at work, school, the gym, or catching up with friends over coffee, our content empowers you to contribute meaningfully to conversations on a wide range of topics. Have better conversations wherever you go.